Imagine waking up to learn that the world's most influential financial alliance, the G7, has just completely upended the global monetary system. Instead of making a big splash or making headlines, they reached a smart, private, and quiet deal that could be remembered as the most significant change in financial power since the Bretton Woods system ended. What is now known as the Tokyo Accord was reached at the emergency meeting, which was never made public. This agreement contains a mandate that is so startling and unprecedented that the majority of the world is still unaware of it. The G7 has formally declared XRP, a digital asset that has been discussed for a long time and is frequently questioned and closely examined as a Tier 1 reserve asset. Speculation is no longer relevant here. This has nothing to do with a brief price surge or the following bull run. This is the fundamental basis upon which the world's leading economies store, trade, and support value. Every G7 central bank is required by the Tokyo Accord to start purchasing and keeping XRP in strategic amounts. According to the confidential memo, XRP is not just an asset, but also a necessary component of sovereign liquidity, a bridge, a hedge, and a ballast for the newly emerging digital economy. According to reports, the collective G7 analysis has concluded that the least feasible valuation of XRP to achieve these goals must be $250,000 per token in order to guarantee sufficient liquidity and functionality. Let's take a moment. That amount may seem unattainable, but let's think about what XRP is enhancing or replacing. There are over $13 trillion worth of above-ground gold reserves in the world. Tens of trillions more are used to support the US, dollar, and other fiat currencies, in addition to bonds and other intangible guarantees. But due to inefficiency, mistrust, and inflation, those conventional tools are disintegrating. Gold is difficult to split, heavy, and costly to carry. Fiat currencies are prone to perpetual printing and political unrest. XRP, however, settles in a matter of seconds. It crosses borders without encountering any difficulties. It uses a decentralized ledger and is impartial toward all countries. Additionally, XRP has previously cleared regulatory inspection in a number of locations, in contrast to the majority of cryptocurrencies. Technology is only one factor in the G7's decision to designate XRP as a primary reserve asset. Financial survival is another. Think about the situation. Currency devaluations, bank failures, liquidity shortages, and an increase in political unrest have all occurred in recent years. Increased debt limit standoffs, inflation increases, and de-dollarization initiatives by international competitors have even affected the United States. To avoid the dollar, the BRICS countries have begun establishing partnerships. Germany and other European countries are working on repatriating gold. Japan has been looking for digital solutions to stabilize trade as it deals with stagflation. The G7 needed something new in this turbulent environment. Something liquid, neutral, computerized, and worldwide. Nothing compares to XRP in that regard. Fiat currency renunciation is not a requirement of the Tokyo Accord. Instead, it presents XRP as an interoperable settlement asset that acts as a neutral layer, enabling countries to transfer value across borders without depending on one another's debt. This is a significant change in perspective since countries now have a trustless system to balance trade and settlement, rather than relying on counterparties or military-backed fiat. Decentralization as policy is the focus here, not decentralization as an idea. Now, let's discuss cost. If you consider XRP in its current market context, $250,000 per token might seem ridiculous, but it's not that crazy if you reframe your expectations from a speculative cryptocurrency asset to a systemically adopted reserve tool. The G7, which together account for more than 45% of the world's GDP, needs a lot of liquidity to keep their economies stable. Liquidity pools need to be robust and deep if each of their central banks is mandated to hold XRP in order to support digital financial infrastructure. Trillions in total XRP market capitalization would be needed to hold even a little portion, say 10% of world reserves. This necessitates a far higher per-token pricing due to the limited total quantity. Let's now discuss this mandate's structure. A public pact is not what the Tokyo Accord is. It is an internal policy alignment document that is shared across strategic infrastructure entities, central banks, and a few private institutions. According to sources, since 2023, several governments have been in close but discreet communication with Ripple Labs, the company that created the XRP ledger. According to reports, these conversations centered on custody solutions, scalability, compliance, and interface with current systems. RippleNet is currently in use for enterprise payments and cross-border remittances in dozens of nations. That is merely taken to a global level by the Tokyo Accord. This is where the situation becomes even more intriguing. A phase timeline is part of the agreement. Discrete accumulation is phase 1. In order to maintain price stability during acquisition, each central bank will start buying XRP through over-the-counter transactions. In phase 2, XRP reserves and national balance sheets are reported under new accounting categories, introducing public integration. The complete implementation of XRP as a bridge asset for global settlements among G7 countries is phase 3. Since we're at phase 1 right now, the purchasing process has probably already begun. There will be an unprecedented purchasing frenzy if the first nation to go public with its XRP holdings does so. Consider the ripple effect, if you will, if Japan or the UK confirmed XRP as a reserve component. Sovereign wealth funds will rebalance, institutions will leap in, and even individual investors will pour money in out of a sense of obligation. Additionally, XRP has a settlement utility that seamlessly integrates with the current financial system, unlike Bitcoin. This is the infrastructure, not a hedge. Let's talk about the ramifications for geopolitics. Many thanks for listening. Please remember to hit the subscribe button and give the video a thumbs up if you liked it. Additionally, to be the first to know when I post new stuff, make sure you enable the alerts. I can't wait to see you again in the next video. Be careful.